Thank you very much, and good morning, good afternoon, and good evening to members of the European House Ambrosetti and friends and colleagues around the world. Delighted to be with you, although as others have said, unfortunately, we are not together in person. It would have been lovely, and I look forward to next time. We do have a very wide agenda to cover, so let me make my points relatively brief. I want to really span the geo-economic and the geopolitical and the geotechnological in my brief introductory remarks before we move on to a broader discussion. Let's hope the slides work. Here we are. Now, the first point I want to make is about this regional level that is becoming more important than before. And I want to emphasize that the trend towards economic regionalism is something that predates the pandemic, but has certainly accelerated during the pandemic. And this is something between the full globalization that we had enjoyed before and the notion of a complete decoupling and renationalization. I call this scenario Continental Drift. We still have significant linkages, especially financial, certainly trade, supply chains, and many other dimensions of globalization. However, what is so interesting to note is the contrast between the global response to the pandemic versus the global financial crisis. If everyone remembers, after 2008, there was significant coordinated effort among G20 governments to jumpstart global supply chains, global trade linkages, coordinated stimulus. And that did have the effect of bringing about a synchronized global rebound in the world economy in the subsequent years. What we've seen in the wake of the pandemic is something quite different, of course, a far heavier focus on domestically directed stimulus, on industrial policy, and on the regional level. It is not a coincidence, in my view, that during the year 2020, during the pandemic, North American nations went ahead with the US, Mexico, Canada trade agreement. The European countries have accelerated this transition from a monetary union towards a stronger degree of fiscal coordination. And Asia, of course, in November, ratified the Regional Comprehensive Economic Partnership, the largest trade agreement in the world. And I think that that is really a sign of how we psychologically respond and politically respond to times of global disruption such as the pandemic. We look within, and we look to our neighbors to extract and to substitute and to deepen those linkages that we had perhaps taken for granted or not fully exploited. Again, clearly, the passage of the USMCA and what's happening in Europe with the regional budget and the fiscal coordination and RCEP were not coordinated actions, right? They are a deeper reflection of a common response. And I think that's very, very interesting. Now, let me focus primarily on Asia for the remaining points. I know that we've already seen a whole host of data around individual European countries and the global performance or projected performance of economies in what is anticipated to be something of a V-shaped recovery, at least internationally, whereas domestically, of course, we have our concerns about K-shaped recoveries. Now, there is a very, very strong likelihood of a high rebound, high percentage growth rate this year among major economies, even spilling into 2022. But where will things normalize? And from 2022 onwards. And clearly, it's going to be a picture in which Asian countries restore their position as the world's growth drivers as they were before. And I think among the key drivers of this are those factors that were critical in propelling the pan-Asian growth in the past decade and a half, 2 decades. One is the demographics, the urbanization, the digitization that's been underway, the financialization of the consumer populace, and innovation. And all of these trends continue, and some of them will very strongly accelerate in the wake of the pandemic, such as digitization. So I think that we need to look closely at each of these areas in the course of our conversation to really understand not only what will accelerate, but how that's going to drive the next wave of the recovery. But going back to trade first and foremost, because I do believe that I'm sympathetic to the manner in which Asians pursue trade integration, not as an all or nothing proposition, but rather something that is quite incremental, in which countries are able to cautiously liberalized sectors that are strategic, that are sensitive, where there's a large employment base, and where there's a strong need to first upskill the labor force before being subjected to global competition. And this is the Asian attitude, and it has resulted clearly in a very, very large success. There's quite a bit to admire, if you will, in RCEP, even though many would describe it as a quote unquote low standard trade agreement. First of all, again, it reflects the pattern of Asian countries learning from the past couple of decades of crises and experience. If you remember back to the Asian financial crisis after 1998 and the reforms that were undertaken at the time, then after the global financial crisis, again, a recognition that one needed to focus more on regional trade integration and bringing down barriers in order to offset the global demand shock. And now again after COVID. So in a way, RCEP, it fits with a very healthy and pragmatic pattern of responding to crisis in Asia. And it's actually the third iteration of such a pragmatic response that we've seen just in recent memory. Now, what are the benefits of RCEP? One of the important virtues, if you will, is that you do see how both wealthy and poorer countries benefit. The wealthier tech exporters are now going to have more harmonized or seamless access to the high growth markets for their high value goods. The poorer countries are going to have less friction in attracting global supply chain activity into their borders, given their lower wages. And again, this is an acceleration of a trend that's been underway. The standardization is a very critical factor generally in improving the trade flows. What we're already seeing happening, and again, this was just before the pandemic, ASEAN had replaced the United States as China's second largest trading partner. And this is obviously quite significant because it's a reflection of how these substitution effects can take place in the context of the trade war, as well as deepening regional linkages. That said, one of the things to watch for is the trade balance between China and its regional neighbors in the years ahead. Whereas ASEAN, Japan, South Korea, and other countries have relatively balanced trade with China, in contrast, for example, to the United States, there is the possibility that given China's very strong economic rebound, its accelerated industrial automation, and other factors, that RCEP is going to be an important instrument for China to more aggressively penetrate these markets, and those trade balances that have been stable could potentially tip very strongly in China's favor, unless Southeast Asia, India, and other countries really boost their productivity and take advantage of that reciprocal access into the Chinese market. I just mentioned India, but of course India has not yet joined the RCEP. I do think in the language of the final declaration, it was a very polite gesture, if you will, to make clear that India is welcome back to the fray anytime. Many of you will know that several reasons that India didn't join, but most significant is that given that software exports are such a critical part of its overall trade profile and that were not covered in RCEP, they held back. And India does have very substantial deficits with all of its neighbors to the east. Now, let me focus, though, on India and Southeast Asia combined, which I call the fourth wave of Asian growth. And this is critical in understanding the overall regional evolution, because the story of Asia's spectacular economic rise of the last 80 years is not necessarily a China-centric story. It's more of a story of mutually reinforcing waves. And of course, Japan is the first wave, followed by the tiger economies, followed by China. And now you have the fourth wave economies of South and Southeast Asia. The countries in yellow, for example. Now, if you take these contiguous states, their combined population is 2.5 billion people. Every one of them, with the exception of Thailand, has a significantly younger median age than China does. In some cases, 15 years younger than China in terms of median age. And now you have them getting more connected to global supply chains. And indeed, what's also important to remember is that Asia should not be understood as a set of competitive national blocks, because this is the story of 80 years, again, of mutual reinforcement. It was the Japanese story, if you will, that inspired the tiger economies, and Japan plus the tigers that really motivated China's reforms. And now the largest investors and trading partners of the South and Southeast Asian countries are indeed their fellow neighbors. And of course, that foreign investment is so critical in raising countries' labor standards and improving their productivity and pushing them up the value chain. So all of these trends that we've seen in the past that have propelled Asia, the already wealthy regions of Asia, are going to be a key factor in the future as well. Now, just a few words about Southeast Asia, rather than read through all the details. The key is to go back to the point about how this region in particular has learned from the past couple of crises. And you've seen a fairly strong stimulus measures on the fiscal side, a focus on tackling poverty, overcoming health gaps, meeting the needs of SMEs and families, particularly at this time, credit expanding to tackle the non-performing loans from state-owned banks, and now thinking about, again, the digital innovation and the ways in which they can use biometric tools to get the economy jump-started and get movement and circulation of people around Southeast Asia going again. Again, compared to 98, compared to 2008, very rapid response, better coordinated, much more, much stronger reflection of the growing capacity of the region. And I think that's, again, a very, very positive sign. On the digital dimension, a couple of words. And the backdrop to this is a hypothesis, that is commonly articulated that I very strongly refute, which is that there is a new global digital Cold War between the United States and China. And I want to point to Southeast Asia as exhibit A in why that's not necessarily true. Because what you see the national champion technology firms doing in Southeast Asia is actually drawing investment from China, from Japan, from the United States, and from others in order to build their own strong domestic foundations, to maintain their data sovereignty, to not only be the strongest players in their local market, but also to regionalize. So what you see happening may be a replication of what has happened in China, but even with Chinese financing, it isn't necessarily becoming digital dependent on China. And I think that actually is a very positive thing. It means that there's going to be quite a bit of continued or stronger competition in this marketplace, and consumers, of course, are going to win while technology standards also improve. And again, this is not an insignificant region, of course, Southeast Asia, with 750 million people. On the eve of the pandemic, Southeast Asia was very, very close to China in terms of the annual volume of FDI inflows, and in its GDP is already larger than India's. Now, going back to the interregional dimension, I opened the presentation by talking about what I called Continental Drift. But I wanted to hedge a little bit and be clear that the world still remains quite globalized, and our dependence on globalization, if anything, has been exhibited and demonstrated by both the pandemic itself and the cutoff of supply chains, on our rapid shift towards digital communication, and this event being just one example of it. And of course, again, another disruption from the last couple of days, such as the blockage of the Suez Canal. So we are still very globalized. And I want to point to a couple of the areas of potential, sort of new potential directions or stronger growth in certain vectors of global interactivity between the three principal regions of the world economy. Now, on the one hand, North America is not going to return to the Trans-Pacific Partnership. That's not a priority for the Biden administration. The United States, in any case, is the least trade dependent of the major global economic regions and is pushing ever more, of course, through its industrial policy, infrastructure investments, nearshoring, and so forth, towards greater degree of self-sufficiency. But the real story, of course, is between the two major economic centers of Eurasia, Europe and Asia, which are the two most trade-dependent regions. And if you see the bridge between them, $1.6 trillion, is the current or the pre-pandemic level of the value of annual trade. And that's obviously set to grow given the Belt and Road infrastructure projects, the new the EU-Japan FTA, the same thing now with Vietnam, that with EU-ASEAN will eventually come into effect. The dialogue is beginning gradually with India as well. So Europe is much more focused, of course, on deepening economic linkages with Asia, despite the geopolitical tensions, of course, with China. On the back of the CAI agreement that came into effect at the end of last year, we have the current tensions and even sanctioning now going on bilaterally, or rather intra-regionally, between China and European officials. I do still think, though, that given Europe's significant dependency on global capital flows and generating revenue to offset its very significant pension obligations, European industry, European finance is quite focused on maintaining that access, growing that access and exposure towards the opening of the Chinese capital markets. And, to make a very important point, finance is the real test of globalization, not trade. Finance, as I always have to explain to students, trade is billions and finance is trillions. So if we really want to keep our eye on the ball, we should remember that the Chinese capital account opening is such a crucial step in accelerating and expanding geographically, deepening global interaction among capital markets. And what Japan and Korea did in decades past, and China is now doing, the next wave of Asian growth economies will surely do as well. So we will see greater privatization, liberalization, and so forth across these fourth wave economies. And so the world will remain very much globalized, and Asia will, of course, be the center of those growth opportunities. So now in my final minute, the final slide, the geopolitical. And since we are hearing so much about the phrase Indo-Pacific, and of course the US Defense Secretary and Secretary of State traveled to Asia last week, and there are areas of tension, I want to be clear, given my own background in geopolitics and military affairs, that even though we have all grown comfortable or perhaps discomforted by this term Indo-Pacific, it is still really three quite distinct geographical theaters with three different trajectories. The Indian Ocean is certain to be multipolar from a naval standpoint, given India's own very strong investments, whereas the Pacific Rim is the highly contested area, particularly given some of the island disputes, and there is potential for conflict there. And the Eurasian dimension, I believe, will be quite stable, given the mutual interest among Europe and Asia and China in particular in driving the continuation of Eurasian infrastructure finance. Even though there are tensions over the Belt and Road Initiative, I do believe that Eurasian infrastructure finance continues to be a very important opportunity and source of growth. So with that, I will stop and hand back over to the chair. Thank you so much.